We're going to start finding out what are the correct things and how are we to do it correctly. Correct? Some facts. So now I want you to answer one question. How many of you have had failures or are still facing failures in trading or investing? A very true question which I'm asking you. You will see there's a research by Morgan Stanley in the 80s which they've said that there are 90% of traders who lose money. Some quote this figure to be 96, 97%. There are a lot of reasons why. We can relate by these 3 points the trading life. When we are young, when we enter the market, when we believe that we will capture the market. So we are naive. We don't have the experience. We believe that the markets will follow what we are going to do. So when we don't even anticipate a loss, so we don't book our losses. So what we do, it's written here, some traders are young and naive and due to inexperience, they overtrade. So the key word here is overtrading, not cutting losses. And you're scared. Moment you see the face of profits, you book it out early. This is the early part of your trading life. This is the reason why 70% of the traders drop out in the first phase itself. Then comes the second phase. The traders' experience and knowledge. That is where they realize that the markets are not that easy as they first thought. So they start gaining knowledge and they improve on the strategies, which is not to overtrade, to cut the losses and not to book profits early. But still they are not profitable. Why are they not profitable? The reason is very simple. They're still not able to avoid the trades which they have to do, don't have to do, and the trades which they have to do. That is where the wisdom comes in. And this is what I have come here personally to share with you, my trading experience. I've not come here to teach you. I've come here to share with you and learn something back from you. So we are working as a team in this part of this webinar. Correct? So we are going to be learners. What you feel is right, you can take back home. You can test it, you verify it. What you feel is wrong, you can throw it aside. That is wisdom. And that trading wisdom is the most important part before we start. Because this is one area which I gained after 7 to 8 years of being a failure as a trader. The things to avoid in trading, that is the key. Some rules, as Vineet has said, we are to follow any question and answers at the end of the session or at the end of the seminar or at the end of a particular closure you can ask me. Because it will make sense, you will not disturb the thing and you will have some time. This PPT and others will be mailed to you in a day or so or by today itself. So you don't have to worry about taking notes. It will all be there for you. So nothing to worry. Enjoy. Let us go this with the journey of trying to know each other and to be better traders at the end of the day. Knowledge is knowing a tomato is a fruit. Wisdom is not putting it into a salad. This is very important. As traders, you must know what is what and what I have to do. That is your wisdom in trading. We will come to that later. What are the things you don't have to do? Correct? Let us move forward. Knowledge comes from learning, wisdom comes from living. Probably. This is the reason why in the second and the third phase, we take a lot of time. We realize that knowledge is important in the second stage itself. But the third stage is the most important one. When you start becoming wise. There is also in life, which is very true. There are only three ways you can learn wisdom, which is one of the best quotes I've gone through. First is by reflection, which is the noblest. Second is by imitation, which is the easiest. And the third is by experience, which is the bitterest. So here I am trying to reflect what I have learned, and here you are trying to take what you believe will work for you in these strategies of Bank Nifty. So let us use this and let us try it out to make it successful. This is our goal, at least what I started off. So I would like to thank Vivekji, Vinitji and the whole team of eLearn Markets for giving me this opportunity to come here. Now, my reason of coming here is very simple. My late father used to say that when you light a candle of someone else, your candle does not lose anything, but the light of the other candle and your candle lights up the whole room. Similarly, when you share your knowledge, you don't lose anything, but the world gains from your knowledge. And when 2 and 2 and 2 and 2 makes, they make 20,000, which in normal case 2 and 2 and 2 and 2 will make 8. So that is the power of compounding and sharing of knowledge. So I would request you, once you complete the webinar, once you get the material, discuss with your friends, discuss what is right, what is wrong before finalizing your strategies. Our goal is to acquire wisdom through observation and reflection, and question our knowledge as to reject the things that do not work for us. So please keep this into the mind before you work forward. I'm not here to give you tutorials of what will work and what will not work. Every individual has a different style. But what works for me, what works for the general people will work for you also. You just got to implement this. So what are the principles of successful trading? We have to remember this. According to John Bender, he was one of the very successful option trader. He was also profiled in Market Wizards. It was a very important series of Market Wizard books where all the successful traders who had made their money and had become market wizards, performing year in, year out. And they were the basis. They were I would say, gurus in a sense. I used to read them before I came into this trading world. And they accepted that these are the three trading methodologies that was there in every market trading thing. Finding an edge in the market. That was the first and the most important part. What is an edge? The edge is something which makes you stand out from someone else. You know that over a period, if you keep on trying this, buying or selling, it will give you money. It could be anything. It could be a price pattern. It could be a volume breakout in a price pattern. It could be something to do with a shareholding pattern. A lot of people have made strategies with shareholding pattern. It could be something to do with open interest. Someone just focuses on new product launches, and someone is on capacity utilization. So everything has an edge. It depends on how you use that to your experience. And that is where is my role in helping you out. I have found some edges in the market which I'm going to share in this webinar. Probably you have to verify it, whether it works or not, and then move forward with it. Second, the most important, which we all find it very difficult, learning to accept small losses in trading. Can anybody give their opinion about this? How hard it is for you to accept losses in trading? Because this is against human nature. We come here in the market to make money, to make profits. So in a psychology, trading losses are never acceptable. Why? Because we come here to make money. There's expectation of our families. You have big expectations. So it's very important. Yes. So if you can book a small loss, if you see the word small loss, if it is not big, it does not hurt you. Correct. The small losses does not help you to come to a situation where you have to average out, and that position is called a gambler's ruin, when you are just being in a market just to survive. Once you cut off small losses, your mind is clear, you're focusing on your next trade, which can be a multi-bag. So it is very important that you accept small losses in trading. Now, how do you do that? When you know your exit on the wrong side is clear and precise before taking the trade. If you are not clear on your loss exit before taking the trade, you are in for some trouble. The third and the most important part is balancing your profits with your losses. A lot of people, they get the favorite setup pattern and they don't understand that they might be wrong in the markets. They risk 20-30% of the capital on that trade. And when they go wrong, they are stressed out. They believe that the markets are not the right place for them. The markets are all wrong. So you have to understand the markets are always correct. At every point of time, it is we who have to adapt to the markets and we have to go. If we are with the market trends, that is where we make money. So you have to balance and have a position size which you do not suffer a gambler's ruin. A gambler's ruin, a gambler, if you've seen a gambler playing, he will keep on risking every money which he has. And when he does not have money, he starts gambling on his belongings and everything else. So if you don't want to get into that thing, you have to accept that trading is a business and losses are part of doing business. This is the most important thing before even we start off with any strategies. If you are not clear on this, nobody or no strategy in the world can help you to become a successful trader. Any questions regarding the 3 principles of successful trading? If you are not clear on this, then probably we'll have to give. How do you define a small stop? Very good question. A small stop is very simple. You have to find an area of entry which is very close to your stop. Very good question, sir. I really liked it. Your entry should be placed in such a way that your stops are near to the entry. It was a fantastic question. I was going to come that, but you've come in before. Right. So I move ahead. What are the key takeaway? This was where always keep a small stop which should be clear and rational. What is the rational? It has to be based on certain elements which has a fixed criteria, which in a very simple way in a pricing pattern will be support or resistance. So you have to understand what is a support or a resistance before you keep a stop loss. We will come there later on. Trade only in any setup where the odds are in your favor. That is another important point. So where are your entries are very important. Trading with the long-term trend and near short-term support levels increases your odd. I believe this is my key point which I take from here, and this is what I have been doing overall to make money. It's very simple which I do it. I will show you with the examples and absolutely we'll work it out. The third and the most important point, never risk more than 2 or 3% of your capital per trade. This has to be your thumb rule before you start trading. How much is my capital? How much I'm risking per trade? You have to have a checklist. So the emotion element is just out of your system. That is very important. If you don't let your emotions come in, you're very safe. Fourth and maximum thing, you've heard about this rule, keep your losses small and maximize and let your profits run. This is what makes, and the wisdom is the most important part here. Whenever you're profitable and your instinct tell you to book, you have to say, have to stop. I will not book here. If the trend is in my favor, I will start trailing. So that's more important. Once you do that, I believe slowly and steadily the wisdom will start to come. So this is the start of the journey. Probably some traders are already here, some investors are already here, they know this. Some of them know this, but probably have never implemented in a system. So this is a process. Now this is the base. Now we build on this base. We build on these processes so that it helps us in our trading life. It helps us to remove the stresses which we might be facing because of the losses. Correct? So now let's come to what is Bank Nifty. So finally we've arrived. All that jnana which was there, probably some people might have liked it, some might not. But it was the most important, I would say, before we come to the strategy. Because that is the base which helps you build the building. So here we are. What is Bank Nifty? One of the most phenomenal words I have seen. To give you an example, in the year 2000, for 1000 rupees of Nifty, you could have bought 1400 rupees worth of Bank Nifty. Today, the situation is that the Bank Nifty, if you're purchasing 1000, it is 2400 rupees worth of Bank Nifty. The ratio of Bank Nifty to Nifty is 2.44. 400 times outperformance Bank Nifty has given in the last 15 years. And it is still outperforming, moving up. And what has happened is, the beauty of it is 12 most liquid and large capitalized stock in the banking sector, which are traded on the National Stock Exchange. So this is actually a sectorial index, which has just banking stocks. And it provides investors and markets intermediary a benchmark that captures the capital market performance of the Indian banking sector. So it's all to do with the banks, and all what we see here is banking stocks have a 35 to 40% weightage in Nifty. And the other most important part here is they have a very high beta. What does beta mean? For every 1 rupee rise in Nifty, the Bank Nifty will rise more than 1 rupee. For every 1 rupee fall in Nifty, the Bank Nifty will fall more than 1 rupee. You can put it in percentage wise also, it's the same. So it gives you faster returns as a trader when you go right. So it is a high beta and it has a higher weightage. Plus being a sectorial index, it is more trending than Nifty. And what the NSE has done, it has launched a weekly as well as a monthly contract. So every week there is a Bank Nifty contract. If you have a view in Bank Nifty for 2 days, you can pay lesser amount of premium in the option market, so use the futures market. And if you're correct, your rewards are much, much more higher than your risk. We will come to that in the option chain. We will discuss this. But now let us move forward. Why Bank Nifty is in vogue? The top 10 constituents are HDFC Bank, 33%. Can you have a look? It controls 33% of Bank Nifty. So this is the bank we have to carefully note. If it is having large outperformance or underperformance, your markets will move. Second is ICICI Bank, 18.9%, Kotak Mahindra 11.66%, State Bank is 9%, Axis Bank is 8.69%, IndusInd Bank is 7.39%, Yes Bank 5.20%, Federal is 1.9%, Bank of Baroda is 1.67%, PNB is 1.11%, Canara is 1%. So these weightages have been taken from NSE India website. You can go through that. These are at the end of the month of May. So you can have a checkup which is there. So this is from the sources nseindia.com, right? So we move forward. The indices weightage might keep on changing. This is as of 31st May. So question which comes in, what is a trend? So as we saw, the important key takeaway was you have to trade in the direction. Yes, sir, presentation will be shared. What is a trend? A trend is a direction where markets are heading. The word direction. So that is very important. As a trader, you must know if the markets are going up, or markets are not going anywhere, or markets are going down. So there are two players in the markets, the buyers and the sellers. When the buyers are in control, it is basically moving up. It is called an uptrend. When the sellers are in control, the markets are moving down. It is called a downtrend. I think so. That's very easy. Probably a lot of people have gone through demand and supply. They understand when more is demanded at a particular price, the market price moves up. And more is supplied at a particular price, the prices move down. And then where the demand equals to supply, there is where is called a market equilibrium. Right? So you basically have to gauge as a market participant who is in control, the buyer or the seller. If you can do that, 70% of your work is done. This is the most important part. Where the challenge comes in, if you're not very clear with your trend and you're not defining a trend, you can be run over by a truckload of emotions. All of a sudden, you might find the markets very expensive one fine day, and you will forget where the trend is all about. Please don't read the newspapers or any other important things, because the trend is only determined by market and nowhere else. Your view and my view will not decide the trend. The trend will be decided by market participant. So as a trader, investor, you must be very sure where the market trend is all about. I might sound a little harsh, but this is a true reality. And the earlier we understand this reality, the better it is for us as traders. Now, this is a very simple example of an uptrend. Right? You can just go see on going. The wave is going up and up and up and up. Right? So, this is one of the perfect case example. More is demanded at a particular price, the price keeps going up. Then there is an equilibrium. If you see the two lines between 21,400 and 22,000, there is where the demand and supply balance has happened. Moment it comes out, you will see there's another breakout. Now please remember one thing, just have a look at the lines. It is between 21,500 to 450, 21,900 to 22,000, 22,450 to 22,500, then 22,950 to 23,000. Please have a look at these lines. You know, these are at 500 points gap. There is a secret here. As a trader, you must know what is the secret. We will get the answer once we come to the option chain. Right? This is a secret, very important secret. Probably it's a power of observation. Once you see this, you'll realize that you have seen this all your life, but you have probably not used it. When there is more supply at a particular price than the demand, the price continues to move downwards till supply and demand are met at equilibrium. This is called a downtrend. So the price keeps going down till the time some demand comes in. Till the time the demand does not come in, that is basically called a downtrend. This is a perfect case example of a downtrend if you see, which happened in January 15. The markets kept going down, went up, kept going down, went up. Now where does this challenge comes in, my friends? How do we define this as traders? Because we come here for a living. We don't come here for academic purpose. That is not your goal. Probably your goal someday is to be one of the world's best trader. If you want to be the world's best trader, probably you'll have to define this trend. It took me about 5 years to define a trend. I tried out a lot of things, but then ultimately what I realized that you have to keep it simple. Once you keep it simple, what happens? Your mind starts to absorb. But the moment you keep it complex in real time, you will forget everything what you plan to do. And keeping it simple, you don't over-optimize anything. Because once you over-optimize anything, there's a possibility of you going wrong. So we go by simple law of demand and supply. I have defined the trend by simple demand and supply. So let's keep it simple. You can work on yourself. You can work on this. I will also be available. If you have any questions later on, you can name me. But let us go it simple. Don't question anything. Just go with the flow. Try to understand. That is more important. Then we'll move forward whether this is right or wrong. This is a very important thing. It's a natural law. Uptrends are classified by higher tops, higher bottoms. And downtrends are classified by lower tops and lower bottoms. Everybody's gone to a beach. Can I have your opinion? All of you all have been to the beach? Great. So everybody's gone. So if you've been to the beach, you've seen that the tide water, when it comes in the coast, it keeps on coming near the sea beach when there's a high tide. And it even enters close to the main roads. So basically, that is a concept of higher highs and higher lows. Similarly, in an uptrend, we have seen the Bank Nifty perfect case example, making higher highs and higher lows. The whole world keeps talking the market is oversold, and Bank Nifty keeps on making higher highs. RSI has gone above 70. You might have heard on the television, might have read on the newspapers that it should correct, but it does not correct. We will discuss this, why it is not correcting. There's one very important technical factor which people are forgetting. The same natural phenomenon can be found in beaches where the high tide water comes near the coast, making higher highs and higher lows. During retreat, the coast water makes lower highs and lower lows. This is natural. What we are doing is confirmed by the natural laws. So we know that we are in sync with the nature. What are tops and bottoms? Very simple. We know everybody is, I think, so aware what is a high. High point of the day is basically the highest point which is made during that day. So we come to know at the end of the day that this was the highest price. For example, if the Bank Nifty opens at 23,500, makes a high of 23,650, that is basically the highest high. Now, when that high is of the last 5 days, right, and the breakdown of the lowest low of the last 2 days which are formed during the period of the highest high. It might sound very confusing, right? Just try to take it one at a time. Tops are classified by the highest highs of 5 days. So we are aware what is a high. We are aware that what is the 5-day high, which is the highest high of the last 5 days, followed by the breakdown of the lowest lay of 2 days formed during the period of highest highs. Now let us take this example. We take this example, if you have a look in the arrows, they are the highest highs of the last 5 days. If you see the line, they are the lowest lows of the 2 days formed during the period of the highest high of the 5 days. If it gets broken, that is basically a top, right? Now you must know what is a top and a bottom, because these are the nuts and bolts of trading. As you go to a doctor and the doctor checks your blood pressure and your sugars and your basic parameters, as a trader, knowing what is a top and what is a bottom is your first and the most important thing, because that tells you the psychology of a buyer and a seller. The tops are made by sellers. Yeah. So what we'll do is, let's come here. This is the highest high of the last 5 days, right? Can you see this? This high is the highest high of the last 5 days. Now what has happened is, this is the last 2 days low. If the highest high is made and it breaches the last 2 days low, we have a valid top. That means the seller has shown his mark here. The seller is ready to sell here. This is the area which is called a supply zone. Now let's come here. This is another top. 5 days high. What has happened is, it's broken 2 days low. Correct? Again the markets went up, made a 5-day high and broke 2 days low, went down. Third time the market went up, they absorbed the shock, and if you see the if you see this has happened here. Is it clear? If you're not clear, just try to absorb it. Just try to absorb it. So let's go once more. Once more. Highest high of 5 days, we are clear here. 1, 2, 3, 4, 5. This is the highest high of 5 days. First step is clear. What you do is, now you underline the 2-day low. The 2-day low is already underlined. If it breaches this, then the top is formed. So wherever you find a 5-day high, you just underline this 2-day low. See, look at here. The 5-day high was made. It did not breach. What has happened? There was no top confirmation. 5-day high, you just draw the line at 2-day low. You keep drawing the line higher. Moment it breaches, it becomes a valid top. 5-day high breaks 2-day low, a valid top. What we are going to do is, we are going to show some more examples of what is a valid bottom. You go through this, it might take you some time. It looks easy, but it is not that easy. But knowing what is a top and a bottom is like nuts and bolts of trading. This PPT is going to be with you. You go through this, you understand, you just have to follow one principle. Go to any chart, that is chartlink.com, tradingview.com. It is last 5 days of trading, any 5 days highest high. You just have to count 1, 2, 3, 4, 5. Just go down, count the 5-day high. Moment it comes, you just have to draw the line at 2-day low. If it breaches that, that means it's a valid top. Correct? Just go ahead with the flow. I can understand some people might find it a little difficult to absorb. It is a technical concept, but it's not that difficult. You go with the flow. We'll come later down here if there is any confusion. Similarly, bottom. Bottom are classified as the lowest low of last 5 days. Very simple. If the last 5 days lowest low was 100 rupees and market breaches it, what happens? We will come to what is the top and bottom, where we have to trade, sir. It is the lowest low. So let us come to an example. Market breaches, see last 5-day low, 1, 2, 3, 4, 5. This is the lowest low. This is the 2-day high. We just have to draw it at the 2-day high. We draw a line. It just, yes, Prakash ji, is the same thing. Moment at the 5-day low and the 5-day high, we just have to draw the opposite line at the 2-day bar. Once we draw it, it is classified. So once we draw this line, you get the highs of the candle. So this is a valid bottom. Now let's come here. 5-day low, 1, 2, 3, 4, 5. 2-day high, 1 and 2. So we draw the line itself here. At the end of the day, you have to draw the line. Straight away when it crosses, you get a valid bottom. Now the valid bottom is basically the power of the bulls. This is a universal principle which can be applied anywhere. My friends, there are a lot of technical indicators who teach about RSI, who teach about moving averages. But until we don't know what is a valid top and a bottom, we cannot go anywhere because they are the basic of price structure formation. This applies to stocks, this applies to commodities, this applies to forex, this applies to any trading item in this world. I think so this was easier than the top. Simple rule, 5-day low, the lowest low of the last 5 days, 1, 2, 3, 4, 5. Moment it touches, draw a line at 2-day high from the day of that low. You've drawn it, it basically goes. This can be used in any chart which you want, right? When you are looking, very important question by Siva, when you are looking at 2 days low, the moment the 5-day low is made, so let us now take an example on a day-to-day basis when we work out. Let's go to charting. We are putting Bank Nifty, correct? Now let's take a live example, right? Now Bank Nifty at this particular point of time, it made a 5-day high. It broke the last 5 days high. So where will be the bottom? 2-day low. So where is the 2-day low for the next trading day? This is the 2-day low. Correct? Again the next day it made a new 5-day high. So where is the 2-day low? It changes. It comes up. Okay. Third day it again made a new 5-day high. Correct? No, we are talking about the trend. We are not talking about the support and resistance. We are talking how to define a top. Okay, so we keep coming here. Now, as the stocks or the index keeps making 5-day high, to define the trend, we have to keep pushing. To define what is the top, we have to keep pushing at the heights. Till the time, no, it should not be continuous. Any 5-day high, not continuous. If you read the thing, a high which is greater than the last 5 days high is basically we have to look at. So now I think so this concept is getting clearer. So as of now, today, if I have to define a trend of a top, it has to breach yesterday's low. Yesterday's low is, this is I think so, yeah, yesterday's low down is 23,000. Probably it's not showing the right figure. It's 15 March, I think so. So probably it is something like 23,420. So if it breaches this particular level, then 23,675 becomes a valid top. Right? So now, is this thing getting more clearer? I believe so. Great. So probably you've learned 50% of what is the understanding. Right, demand and supply. Now we will come that later. First, let's go step by step. I can understand the excitement of people. They want to get it on a faster note. But then we have to understand to go step by step. So this is the step you first brought out the power of the seller and the buyer. The top is the power of the seller and the bottom is the power of the buyer. So now we at least know where the seller and the buyers are active. So if someone asks you in the chart price, you'll be able to tell them that this is where the seller is active. And if the seller is active at one particular price point nearby 2 or 3 times, it becomes a zone of selling area. Correct? So let's move. Rules about top and bottom. Very, very important. When you're finding tops and bottom, you must remember that only after validation of a top will you search for a bottom and vice versa. Let's go to the example. What happens is, a lot of people get excited. They say that this top, this bottom has been formed. Lowest low of 5 days and it is moving up. But it is very important that first the top has to be confirmed. If the top is not confirmed, if you have a low, this top, this was the highest top, this was the 2-day low, did not breach. It made a 5-day low here, but that bottom cannot be validated because still now the top is still not validated. If it had broken this level, then only this validation could have happened. So this is one of the best case by example scenario. Market makes lows of 4-5 days, but the major trend, it has not even broken a valid top lows. So this is one of the best areas where the market tells you it has given a price correction, but the damage, time correction, but the price correction has not happened. So market might make a fresh up move. So this validation, once you define what is a top, the top has been formed, then only a bottom can be formed. So bottom cannot be formed before a valid top has been formed. Similarly in the case of bottoms, first the bottom has to be validated. If the bottom is validated, then this is going to be there. Correct? So this is, sir, my experience of my trading sharing which I am doing with you. Probably it might be good for you, might not be, but this is what is a trading experience which is all about. So let us move forward with it. If it works for you, then it's yeah. What is a valid? A valid bottom is the price makes 5-day low, again goes up. In normal case, had this been a top, then this would have been a valid bottom. It had made 5-day low, it broke 2-day high. But in this case, the top has not been validated. Right? So this is just one of the rules of trading. You have to first validate a top before you validate a bottom. If the top is not yet validated, it does not break 2-day low, it is not validated. This top has been made, but it did not break 2-day low. So it is not a valid top. So you cannot form a bottom formation here. Right? So let's move forward. So what is the conclusion? The tops and bottoms are the base of trend formation. The uptrend is classified by higher tops and higher bottoms. Downtrend is classified by lower tops and lower bottoms. So now when you know what is a top and a bottom, you can now form the wave analysis. You understand if the market is making higher highs, higher lows, or higher tops and higher bottoms, then you are in an uptrend. And the downtrend is very similar to this. So first, you must be able to point out what is the top and the bottom. Then you have to understand whether the markets are making higher tops and higher bottoms, then they are in an uptrend. And this is again, lower tops and lower bottoms is classified as downtrend. How to catch a change of trend? So now we've understood what is a trend. The trends are classified by higher tops and higher bottoms. So now once if you're able to identify the top and the bottom, your job becomes very easy. Now what you got to do? As a trader, you have to understand what is an uptrend, what is a downtrend. For that to understand, you must know what is the change of trend. So from a downtrend to an uptrend, for an uptrend to a downtrend, you must be able to understand. These are little technical points. At first, probably it might be a little difficult those who are not following. As you start following it and implementing it in the various time frames and the charts, you'll start to grapple it and come in terms with it. It is not that bad. It is with the price, so it is very natural. It is not a price derivative. So let's move forward with it. The change of trend from a downtrend to an uptrend is classified by higher top, higher bottom compared to the previous top and bottom, followed by the breakout of the first higher top. Now we are very clear what is the top and the bottom. So 5-day high, broken 2 days. This is a valid top. It breaches. This is a valid bottom. Low, 2-day low, 5-day low, broken. You can say consider anything. This is what I use, Vishal. I use 5-day because it is a good trend because we consist of about 5 days. So in a 5-day period, if a stock is making a low or a high or an index is making a low or a high, it gives you a lot of incentives. You can do it on a 2-day basis, 1-day basis, but that will lead to a lot of whipsaws in the trend deciding strategy. So as a trend deciding strategy, one must be very clear that the trend does not whipsaw time in again. So it is always better to use a larger time period, 5-day, 6 days, 7 days, or minimum of 4 days. Not below 4 days, I will not suggest you. Right? So this is a lower low. So till here the trend is down. If you can see here, the trend keeps going down. Can you see? Can you see the mouse pointer also? Right? So from here, the first area of indication here is it breaches the high. Moment it breaches the high, what is it? This is the area of concern. So the natural phenomena of a sell trend has reversed to a neutral trend. Then again the market comes up, it makes a higher low. This is one area where the trend can change very fast. So this is a neutral trend. Right? Now, moment the market breaches and makes a higher high, this is where we get the start of the uptrend. Right? So, first let's be very clear. A downtrend is followed by what? A lower top and a lower bottom. Always remember, uptrend is higher top, higher bottom. So, first thing is, when the trend changes, the first and the important thing is, from a downtrend, the first trend change will be higher high. Correct? Higher high. So moment this is an area of concern that the trend might change, I have to be neutral in the market. And the second correction, moment the market corrects and it is still above this low which is formed, that is the area that 70% the trend will change. And that confirmation comes when it breaches this. Now there is a question which comes in that some might always ask, the trend is at 17,600 was the low, the trend changes at 19,300. Very important question. A lot of people have asked me. When you are defining a trend, it's very important to understand that you don't get whipsawed in the trend. So it is always better to be patient and you must have your systems in check, which time frame you are trading, that you don't go against that trend. So this particular period you might have lost money when the market was going up. But the whole period downwards, you made money. So there might be in the trend change phase that you might lose some money. Right? So this is very important. Is it clear? So uptrend, let's take this example. Where is the uptrend? So the downtrend is classified by lower tops and lower bottoms. We can see here the markets are continuously making lower lows, lower highs. The first thing what happens is lower highs get breached. That is the area where as a trend change you have to open with your eyes. So lower highs become now higher highs. So the first criteria has been set. Then what we require is a higher low. Very simple as we discussed. And then we require a confirmation of the higher high breakout. This is the start of the uptrend. Right? Is it making sense? I want opinion. Thank you, Manoj. Thank you, Kangan. I think so, yes. Very good. This is the base, sir. We got to understand this. If you do not understand this, then probably the buyer's side and the seller's mindset is not very clear with you. Fantastic. I like this review. I'll repeat it for Prasanna. Prasanna ji, the trend is for an uptrend, higher highs and higher lows. And for a downtrend, it is lower high, lower low. So when the trend is to be changing, the first thing what we see is the market breaks the lower high. That is the first area you have to understand. The market becomes neutral. So in this particular case, the market did this on the 9th of February when it broke 18,750. The highs got broken. Then you entered the neutral zone. The market went and made a high of 19,260. Then again went a valid bottom at 18,760, which was a higher bottom at 17,650. And the continuation of the trend became clear when it broke 19,250 that we had the start of an uptrend. Right? So now the fundamental rule here is, as a trader, you are going to basically stay on the side of the trend. If the market is in an uptrend, your trades are going to be on the buy side only. If the market is in a downtrend, you're going to be on the sell side only. Correct, Neil? This is what I do. This is my judgment of trend. For you, it might be different. You can take 7 days, 3 days, 9 days, 5 days. This is what I do as for a trading as a living to find the trend. It has worked for me. For you, it might work. Something might work better than this. But you must know what is the base first to decide what is a trend. If you don't know that, you cannot work on the next step. Probably, this is not textbook stuffs. Probably go down to the net. Anyway, you will not find this. This is actually all done indigenously by me. Worked it on 10 years of Bank Nifty research. Believe me, 10 years. Before I come to this conclusion, this works for Bank Nifty, Nifty, stocks, everywhere. Right? But on the same day, downtrend, uptrend cannot happen because at the end of the day, the trend will be decided. Correct? So the same day, we will not have a buy trend, sell trend. You can have a look at it because at the end of the day, we draw the line. Correct? So you have to experience this. It's very simple, Girish. You basically go 5-day high, just fix the line wherever there is a new 5-day high, fix the line at 2-day low. That's it. We will do it in the chart. We will do it in the example later on. So let us first go through the basic. I believe that's great. Yeah, for the trend, I only use the daily chart because I will come down to my entry and exit level. We will come later. There is where we use intraday charts. The change of trend from a downtrend to uptrend. Yeah, that's great. We will take up examples. Don't worry, Prasanna ji. I am there. I'm not going to leave you. At the end of the webinar also, if there are any queries, I will take your queries. You can mail me. Vivek ji, Vinit ji, please make sure that anybody who mails me with his queries, please send to me and I will respond back and reply back. Please be relaxed and be rest assured I am there. Right? The change of trend from a downtrend to an uptrend is classified by higher top followed by a higher bottom compared to the previous tops and bottoms followed by the breakout of the first higher top. Right? Again, what we did from a downtrend to an uptrend, we are doing the same from an uptrend to a downtrend. Right? Let's take this example. What has happened? This was a higher high. Sorry, I just gone there. Higher high. Markets keep going down. Made a low. This is where the lower low was made, which was the first low. Markets went up. This was the low, previous bottom. The market broke that. Lower low was made, lower high. And the breakout of this lower low. Now I think that the concept will flow. It should flow basically. This is the valid top. Oh, sorry. Again, it's going. The mouse is playing games with me. This is the valid top. This is the valid bottom. Right? The bottom, the first bottom gets breached, lower bottom. Again, a lower top compared to the first valid top and the breakout of the lower bottom. So, this is the start of the downtrend. So, now any opportunity we have to use to sell. So, when you start plotting this trend and then when you're very clear that you have to play one side of the market, you have 160% of the battle. Believe me friends, the confusion is whether I want to buy or whether I want to sell. Now, if you're very clear that I just have to buy or I just have to sell, you become very clear in your mind. Then you have to focus on which entry levels. This trend I use in the daily chart. Now, supposing you're a very long-term player, you can use this in the weekly charts to define the trend. Right? So, you have to focus what is your time area. In India, we have Bank Nifty options which are for 21 days to 30 days, that is essentially 4 to 5 weeks, and weekly options which are 3 to 5 days. So your focus as a trader in futures option should be in short-term purposes. So it is ideally best suited to find the trend from the daily price levels. Right, sir? This is why I use the daily charts, and this is why I use the 5 and the 2 concept. 5-day low and the breakout of 2-day high. The trend is very clear. If you see, the last trend breakout took place in 2017 January end, right? The lower bottom is here. Very simple. 19,750. This is the bottom breach. So this is the lower bottom which has been made at 19,050. And then again the lower top, and this is where it has happened. This is the method of identification of trend which I am using. Probably you can make it better. We are going to be there as partners. I am going to take your inputs. We are going to work together. And if you find something better, if you have any suggestions, I am there to change. I am there to open up. Yes, the breakout of the lower bottom is the start of the downtrend. Very correct, Shiva. You got the concept clear. Now, you got to use the trend 85% of the times. There are certain times where there are trend changing events. Exceptions events are like credit policies, global meltdown, poor results of major weightage, and banks. Correct? Yeah, the markets, the trends can reverse. From there, the markets can go up. It does not necessarily mean that the downtrend has started, the Bank Nifty has to fall from that price itself. So that is the reason we have the second check when we take and do our trading entries. So we'll come down to that. So don't worry. That is just a trend. That is an indication where the buyers and sellers are there. After that, we are going to come. Where are we going to make the entries and exit? Don't worry, Shiva. We'll work this, and Arunji will come there. But its more important thing is you got to be very sure that you're trading in the direction of the trend. The trend might go against you also. But then as a trader, you must know where are your entries and exit points where you can make money. So you have to have exceptions like credit policies, global meltdown, poor results, and major weightage banks. These are the days where markets might not take the trend and markets might move in that opposite direction. I determine the trend from the daily charts, then I look for low risk entries in the intraday chart. This is what I do. So now one thing is very clear. If I know that the trend is in my favor, I know I have to play on one side. It does not mean that it gives me a guarantee for money, but it gives me an edge, and the thing tells me that I have that edge in my favor. absolutely correct that the edge is in my favor. This is what is an edge. This is what I've developed. I've seen 70-80% of the time when I play with the trend and with a very small stop loss, I make money. So I determine the trend. I've got the trend. So let us now come down and look for low risk entries in the intraday charts. Finding the demand and the supply zone. This is one of the very important thing in an intraday chart. We will discuss this. Is a price cluster. Now we have seen the tops and bottoms. When there are 2-3 bottoms in an intraday price near each other, 30 point, 40 point gap, that means that is a zone which becomes a support area. That means that the buyers are there which are interested in buying the market. This is again assuming that we are in an uptrend. Similarly, what is a supply zone? A supply zone is a price cluster where there are 3 or more tops in the time frame of 5 or 15 minutes, which means that the sellers are interested in selling the market. Now, one very important caveat here. If the top is 23,500 and in that 20-30 points there are 2 or 3 bottoms, that's not valid. It should be at least 80 to 100 points, 0.45% area from the recent high or from the recent low. If it is in a trading zone, if it's in a 20-30 points and there are 2-3 bottoms, it becomes a trading zone. It's not a support area. And in an uptrend, we try to enter a supply zone or wait for the breakout of the demand zone. Volume will play a key role in determining the demand zone has been broken or the supply zone has been broken when there is above or below average volume. So we'll come there. What is a breakout and what is basically a support and a resistance market, right? So before I go there, now let's take examples. I think so most of the people are curious for examples. Sorry. So let us go. This is the daily chart of Bank Nifty. Can everybody tell me this is a very clear higher tops? This is a top. This is a bottom. It's a very clear uptrend market. Is everybody very clear? Right, Shiva, thank you. Thank you, Arjun. Thank you, everybody. So we are now understanding from the concept of tops and bottoms that markets are in a very clear uptrend. Now, very important thumb rule, which I am telling you, and this nobody will tell you in the books. You will not find it in Google. You will not find it anywhere. This is just my experience, which I am sharing with you. Whenever any instrument breaks an all-time high after a period of 12 to 18 months. I'm again clearing it. Whenever any instrument breaks all-time high after a period of 12 to 18 months and it sustains above that level for 2 trading sessions, it might give you a return of minimum 15 to 20%. It might continue for a period of 20 to 30 weeks. You can validate this, you can test this. This is actually, no books will tell you this. All-time high breakout of a period. This is the all-time high, my friend, and it is made in the month of February 2015. 20,000, 21,000. It breaches after a period of 2 years in the month of 20 months after the period of, exactly 2 years. In the month of April. And you just have a look. 21,000 is 23,691. You can back test this. You can validate this. All-time high breakout after period of 12 to 18 months is a very powerful indicator. Never try to sell that market, at least for the next 15-20 weeks, if it is above the price level of the previous all-time high, right? So we've already, I think so, the 15-16 week of that all-time high breakout. The trend is a buy, the very clear buy signal. So this is one thumb rule, please remember. All-time high after a period of 12 to 18 months, you should keep that in mind. You have a secular bull run in that stock or that index. So we are actually currently having a secular bull run in Nifty as well as Bank Nifty. Both are trading at all-time highs. Thank you, Prasanna ji, for your nice words. Now let's move forward. So the trend is very clear. It is buy. Now what do I come? So if you are a new trader, these are all the free instruments I'm using. There is Zerodha, which gives you intraday data. There is Trading View 14. This is that website. So you can use that website also. So this gives you the intraday data. Yeah, it does give you. This is again for a academic purpose. I agree with you. What we are going to see is there are a lot of people who might not be live traders. So they're just getting into that concept, right? So that's what the whole idea is all about. And what we simply do, this is a 5-minute Bank Nifty chart, right? What does the chart tell you? What we've discussed? We've discussed very simple things. That the trend is a buy, we are going to buy. So now where should we buy? Right? So basically what we got to do here is you basically got to put in a very simple tool and a very powerful tool that is basically called a moving average. Now, moving average is just nothing but the average price where the buyer and sellers are fighting in the market. So what we do is we take the moving average of 200 period of close. Very simple. We don't need to offset anything. Is everybody able to hear me? Is my voice audible? Right. Thank you. Thank you. That's great. Now what you're looking here is very simple. I am looking at areas to buy in the 5-minute near the 200 where the demand and supply zones are there. Because my trend is very clear. It is a buy. When it is near and above 200 moving average and when there are buyers and sellers, just have a look at this area. Valid tops, valid bottoms. Now, what we are doing is we look to buy somewhere around this area, about 200 moving average. Our stop is very close to this particular area. You can go validate this. First, find around the 200-day moving average. I might find reversal points. And in a 5-minute moving average from the recent high, market has to correct minimum of 70 to 100 points. The first criteria in Bank Nifty. From the highs, the market has to correct 70 to 100 points to come at 200 moving average. When it has corrected that, what is to be done? You got to then focus on the demand and the supply of the markets. What you're seeing here is in the 5 minutes, there's a lower top, lower bottom. But this concept changes here. Then it takes a support. It breaks here. This is my area of entry. What is my stop? Very clear, this level. So my stop, what we had discussed, in that area of cluster, this is the area of cluster between the demand and the supply zone, near that area, if the cluster breaks out, the stop loss has to be very clear and a small one. So when you are buying in this zone, 23,587, your stop loss is 540 and below that level. So you're playing with a 50-point stop loss in the trend near the 200-day moving average of 5 moving average. Now there was a question with the gentleman that asked me that, sir, the trend changed in the daily chart. We are using a second filter, which is a 200 period moving average in 5 minutes. So if the price is below 200-day moving average, we will not look to trade in that market or the instrument if the trend is up. So now let's come down and have a look. In an uptrend, you will see the prices staying above 200-day moving average for most of the time. Am I making sense now? We've defined the trend, how things become more easier. Just go 200-day moving average, just have a little support, and it's in moment it is forming a cluster or a zone near that area, you look to buy with a very small stop near the recent bottom. Just take some time to absorb. Just take a minute to absorb what we are discussing. This area where there are recent highs, they call supply zone. It comes here, goes break, and moment it breaks this and takes the support, this top bottom has been taking the support. When you might have heard the saying, when previous support become resistance, that is the area to sell, and when previous resistance become your support, that is the area to buy. Just have a look at this chart. Your previous resistance is now acting as a support, right? Yesterday's prime example. Right, I'll do that, sir. Thank you for your suggestion. Just have a look. This was the area of zone. Yeah, 5 minutes, first 5-10 minutes is the most volatile time during trading. Whenever the market crosses this with heavy volumes and sustains above the low of the first 5 minutes in the moving average, that is one area. When the market has broken 200-day moving average, there was one particular day on the clearing day. This was this example. The market was not able to move about 200-day moving average. This was the clearing day. Market gave a breakout in the opening, the closing, and it maintained. Just have a look. What did the market do? So markets were in a demand and a supply zone. 24th, this was the area where the markets was making lower lows. We were not trading here. But the moment the market sustained above 200 moving average and made one cluster and gave a breakout of that cluster, the market zoomed up. There is another secret research which we are going to come, that will be in the last and the most important part. That is an Excel sheet. It's a proprietary trading tool, Excel, which will show you. See, trading was so simple. Believe me, I am sharing my experience. Yeah, how the clusters are formed. Very simple. We discussed demand and supply. Actually, since it's a 5-minute chart, I'll just show you. What does the market do? Market formed highs and the lows. This was the high. This was the low. This was another high which was there, which was previously made. This was another close by high which was previously made. Right. 200-day will act as a support and resistance. The price, if it's in an uptrend, will only be 15 to 17% of the times in 5 minutes below the 200 moving average. You can do that statistical research. You can put your prices in Excel and check up that in an uptrend, the prices will be in the 5-minute chart 70 to 75% of the time above 200-day moving average. That is the beauty. So when it comes near the 200-day moving average, you know that there is a 25% time the prices will be just below that. The prices are at an ideal buying area. So you're playing with historical edges in your favor. Very smart question, and I believe a lot of thinking has gone into this. So now this is a cluster. Why this is a cluster? The previous highs are also there. The market is taking resistance in this particular zone. If you see the highs and the lows are being formed, the prices are not moving much. Gives a breakout. This volume, now we don't have volume charts here. Anybody who's trading futures, please remember, any trading volume of above 1 lakh Nifty shares in index future in 5 minutes is above average volume. In this bar, there was a volume of 2,40,000. We don't have it here, so this is a free tool. But if you have a tool, technical tool in zeros or anywhere, you can go down, backtest that data. There was 2,40,000 volume. The price gave a breakout with heavy volume. So what we had discussed, demand zone and supply zone. Moment it gives a breakout with above average volume in a supply zone, That means that becomes the buying area of the future. So if you see it's above 200-day moving average, if the prices are in a range, it has broken with a huge volume and a price of 5 minutes, just see 100-point tick. So as a trader, you got to understand that where the price, the breakout of the zone, including the volume support, you are going to have a very big explosion. So these are your odds in your favor. I hope you all are getting to the flow of it. As a trader, what is in your favor? The daily trend. Point number 1. Point number 2, be 5 or 15 minutes, 200-day moving average. Price clusters around those 200-day moving average. Point number 3, finding the big area of zones, resistance and demand zones. Point number 4, finding the breakout of supply zone with huge volumes. Now take another example. This was a demand zone. If you see 1, 1, 1, price gives a downside breakout, but it does not sustain because there was no volume here. This is a problem with the software. It's a free software. It keeps giving updates time and again. But it's a very good site. It gives a breakout, but there was no volume. And moment it broke out of above 200-day moving average, just have a look how the prices spurted up. Right? So this area, I'm not interested to trade. Below 200-day moving average, it does not sustain above 200. Again goes. I will not be selling here. I have made it a principle. I just trade at one side of the trend. I'm not interested. If the prices are below this and the trend is a buy, I don't want to sell and earn 50, 100 rupees. I want to make sure that my stop loss is 50 to 60 rupees and my profit targets are 100 to 100 rupees. Now, you might say 100 rupees in Bank Nifty is not much. But as an option trader, those who are trading options, and if you can catch 100 rupees, you can make profits of 50% in trading options in a single day. Right? Is this making sense, my friends? Right? Thank you. Great. Fantastic. So people are making sense of this. I think so. When you are trading, or if you have traded this, you can connect through this. What are the 3 important points? Again, I'm repeating for the users. Please understand. What are the principles of fundamental trading we discussed? Number 1, you should have a trading edge. So what is a trading edge we have? On the daily charts, we are finding the trend. Correct? Is this clear? That is the number 1 edge. Number 2 edge, we are coming to intraday data. We are finding clusters of support and resistance to the tops and bottoms near 200-day moving average. Why 200-day moving average? Research has shown, and as I've shown you here, prices are only down in an uptrend below 200-day average about 15 to 20%. So big price move takes place above 200-day moving average as we have seen. Great. Near that area, I look to buy. Third, I require the volume confirmation if it's breaking a supply trend. I have given you in 5 minutes an average volume above 1 lakh is one of the very big indicators that this is a breakout market. Sir, very simple. We are using it simple. 200-day simple. Let's not make it complex. This is about T+2 trading days strategy. You can carry it for the next day because the trend is in your favor. You have to basically do position sizing as well as keep booking your profits by trailing your stop. Right? So this is where you as a trader, I have taught you my methodology, which I have made money. I have been making money since the last few years. I did not make money. I'm going to share this experience. I did not make money for the first 5 years. I lost money. But every time I lost money, there was nobody to guide me. I had to do it all by myself. Because you used to touch on one thing, as you said, RSI, I did MACD, I did this, I did that. But they never used to focus. So then I focused. if everything is dependent on price, why not search from the price itself and the buyer and the seller? This is what brought me to this strategy. And believe me, friends, once I'm following this, my mind is clear. I don't even open up the newspaper on the morning to decide what is to be done. My trend is clear. Prices are sustaining around 200-day moving average. There's a cluster of buyer and seller. If there is a support which comes in, I buy it on a breakout and keep a very small stop near the recent low. So now are you understanding what the top and the bottom we are doing it, right? Don't worry, those who have joined, it works everywhere. Those who have joined, you will get this PPT, you will get the Excel sheet which I'll come later on. Don't worry, this too early you've joined, my friend. So let's work out on the other thing. So now let's come down to the further thing. So we've completed on the charting part. What is a trend? How do we define a trend? How do we use it for our trading purpose? Now we have to get some wisdom. We have to get some more market tools to understand what is going to help in the particular thing. Option chain is one very important tool which I have learned to confirm my pricing patterns. You know, I told you something in the beginning about the charts at 500 points. The market was forming a range, 23,000 to 23,500, 23,500 to 24,000, 22,000 to 22,500. Those things were there, if you remember. So the answer here is in that option chain. So what you have to look in the option chain, and what is an option chain? A very small description. I'm not going too much into it. What you should know as a trader's wisdom, you have to understand. Bank Nifty option chain shows us the various strikes, the call and the put, and the premium along with the open interest position and the volatility in a chronological order. You don't have to work anywhere, my friends. You just have to go to nseindia.com, go to the live market, go to equity derivatives. As I had told you, this is the Nifty option chain, right? So we are trading in Bank Nifty. We'll have a Nifty seminar also, or this thing, if there is a demand, we will work it out, and then we might do something on a live basis if you guys are keen. This is a Bank Nifty. If you go there, this is a Bank Nifty. The contract date, expiry date 15 June, as I told you. There is 15, 22nd, 29, 6 July weekly contracts. And the last month of the contract is the monthly contract, right? So let us come to this weekly contract. The weekly expires on 15 June. What do I get? This is the call and this is the put. This is the strike price, right? This is the open interest. What is the total number of outstanding contracts remaining? This is the change of open interest. What is the change in the daily basis? Whether the contracts have been added or have been reduced. This is the number of volume. It's okay, not very important. This is the IV. IV is determined by the option price, right? From the premium, you get the IVs. This is the traded price. This is the buyer seller. This is for the puts. Now basically, just for the sake of my users, I'm making you just a brief introduction. If you're bullish in the market, basically you buy calls. The buyer for call has a right, but not the obligation. That means you're paying the premium. If the market price goes above you, your loss is limited to the premium you have paid. Similarly for a put, if you expect the markets to go down, you just buy the put. Your maximum loss is the premium amount you paid. If the market goes down by 1,000 points, goes up by 1,000 points, you don't have to pay anything extra from your house. The seller is the opposite. So we are focusing on right now the buyers who have the options. So basically, as of now, you are bullish in the market. So what you will do, at that clusters, what you look to do, you look to buy calls. Now, you look to buy calls. Now, very important thing. What should you look at? Traders should look at the strike price where the open interest is highest in call and puts, which indicate the natural support and resistance around the strike price. Wherever there is a highest open interest in the call, it becomes a resistance. And wherever is the highest open interest in the put, it becomes a support. What do I mean by that? Let's go to the option chain. This is a weekly contract. This is a monthly. Let's first come to the monthly contract. Just have a look at strike prices of 500. 23,500 has an open interest of 5,19,000 contracts. The 23,600 has just 52,000 contracts. 23,700 has just 45,000 contracts. 23,800 has just 36,000 contracts. So just have a look. Round figures: 23,000, 23,500, 24,000. All the round figures have major open interest. Look at 22,000, 5 lakhs. 22,500 put 5 lakh 60. 23,000 put 9 lakhs. So the natural support and resistance which we had discussed, my friend, 500 points gap, you can draw it. Moment, as of now, it has broken that 500 point gap. 23,500 has been breached. If you have a look, just draw lines at those 500 points, you will understand the secret of the market. Right? Just keep drawing the lines at the 500 levels. You will find the support and the resistance which are naturally which is happening. So a lot of times we ask questions, why is it not breaking 23,500 or 23,000? So right as of now we have just broken out of 23,500 and we have closed 2 days above it. There is a very high probability till the Bank Nifty does not close below 23,500 that the markets might go to 24,000. That is what the option chain is right now showing us. Right? 23,500 has an open interest of 5,19,000, my friend. The open interest 3 days back was 11 lakhs. About a week back, you can check up that open interest. So they are cutting the open interest at 23,500. Just have a look. 23,500 put has open interest of 6,67,000. Your prices are sustaining above 200 moving average. Your open interest in Bank Nifty, the secret is having a look at 500 points. Round figures. That is the secret. This is a monthly contract. So it tells you that there is huge bullishness right now because it has broken out of that resistance of 23,500 for the last 5-7 trading session and sustained above for 2 days. So what I have to look? The strikes where the open interests are there. So it is telling me that the strikes are there in the round figures. Right? 23,300 has open interest of, is just 42,000, right? 23,000 has 9,39,000. That is bullish. When the puts have higher open interest at the lower level, that acts as support. So now the highest open interest is 5,19,000 and you are above that level. So it is a very bullish indicator. Going forward, the prices are going to break that. So 24 is also not a very strong resistance. Right? So let us now recap what we've understood. We look for highest open interest. In Bank Nifty, the highest open interests are in the round figures. You draw those lines on the charts, you will come to know those are natural support and resistance. When they break it out, the point market tends to move towards the next round figure that is right now 24,000. Now what is the other time to look? So as a trader, I want to make a trade for a short term period. The market is a buy. So as of now, it is 23,700. Okay. So what I want to, if I want to buy, so I am expecting 100 points profit. So I am buying a 23,900 call. And if it goes up to 20, market goes up by 100 points, this call will rise in the option chain to about 58, 59. So another thing which the option chain tells you is that if the market goes is to go up by a certain percentage point, what approximate will be your value of options? You can see it from the option chain. Right? So let's come here. Example, you bought a 23,900 call at 33. Market goes up by 100 points. Your value of the call will be approximate 54 to 55 rupees. Just subtract 3-4 points because the premium, there is some time value premium which will move out. The market goes up by 200 points, that value of your call will be around 87 to 88 rupees. You just have to go up 200 points in the chain, right? When you're buying call. Now similarly, if the market goes against you, very simple, sir, 23,900, just an example. If you want to invest more, you ideally should buy 100 points above. 23,800 to 23,900 depending on your risk appetite. And if the market goes 100 points against you, your 33 rupees call will come to about 19 to 19 and a half. So this chain gives you an approximate value. You don't have to be a A-grade option trader to find the values. The option chain is a good enough guide, my friends, for you to understand what will be your risk reward ratio. So when you have a 40 point, 50 point risk, and when I'm buying a 33 rupee call, so I have to assume that my call value will go down by 7 rupees if it goes against me. And if it goes up by 150 points, I will start to make about 70 rupees, 35 rupees. Right? So now let's take an example. So supposing I'm bullish in the market, my stop loss is 50 points from here, right? 23,690. I'm buying a 34 rupees call, and my stop loss gets triggered. So what will be my loss? And if it had fallen by 100 rupees, my loss would be 34 minus 18, which is the value of the next strike price, 15 rupees, right? So if it goes down by 50 points, my loss will be about 7.5 to 8 rupees. It's an approximation. Now if the markets are to go up by 100 points from there, what will be my profit? It is 58 rupees minus 34, 24 rupees. Right? So I'm risking 8 rupees to get 24 rupees. The risk reward ratio is 3:1. In actual, my risk reward ratio when I'm buying futures is just 2:1. 100 rupees profit to 50 rupees loss. So if you are an intraday trader and an option buyer, and you know that you have an edge, that you can make money if the Bank Nifty goes 100 points in your favor, option buyer makes more money than a future trader. This is what I wanted to highlight you in this option chain. So sometimes people say that people don't make money in options, but if you are smart, your stop loss is clear and defined, and you understand the market dynamics, option is one of the best things to happen to you. Last clearing, day 25th May, 20-30 paisa options started trading at 300, 400 rupees. If those guys who are trading is anybody trading, my friends out here? Oh, yes, Manojji, probably if you are trading, yes, the last month of the monthly contract, there was there. Great. So probably you all are aware. A lot of guys are trading, so they know the value of options, what options can do to you. If you can control your losses, my friend, option markets. So the second and the most important point, what I told you, what you have to look. Right, great. So probably we are there. So the second part of the option chain, you guys have understood, right? Now the third, this is what was the second part. How do you define the profit and loss? By having a look at the option chain. The call and the put buying or writing can be seen live. Now this is one other important point. When you are trading live in the market, you can see the changes in the market view by seeing the change in call and the put writing or buying, which is a good indication as you see in the markets, which I told you for the option chain. So sometimes, there's a big hoopla about option. Oh my God, you got to be Greek and I don't understand this. But believe me, NSE India has done everything for you as a trader or an investor to understand everything. My friends, I know I am just behind schedule by 10-15 minutes because I should have started with the question answers. But I hope you guys will not mind staying with me for the next 20-30 minutes extra, because there will be a question answer for the last 10-15 minutes. And now we are coming to the proprietary tool. So probably I've explained to you the option chain. Right? Yeah. Thank you for your support. So now let's come down to the proprietary indicator. This is the indicator which I use. Let's come down. This is nothing, my friends. This is the monthly clearing high-low from Friday, the first day of the clearing to the last day. Right? High-low close. Thank you, Bala. Thank you, Bala, for the feedback. There will be a feedback form which you will get after 10-15 minutes after we will start the question and answer session. High, low, close. This is nothing but it just tells us what is the market tendency over the clearings, right? So first we'll start with the weekly clearing. As you know, the weekly contracts are there. These are nothing but percentage close over weekly basis. How does the Bank Nifty work? Volatility is nothing but high minus low of the weekly session, which we are getting in round number. Then there is another volatility which is nothing but high minus previous highs. Please don't get flumbustered or this thing. This Excel will go to in your mail ID along with the PPT presentation. Even for those people who come in late, who not listened, you're not understanding, don't worry. You will get this Excel. The formulas are all there. You can go through it. Those which are colored in bold are your monthly clearings. You know, the last Thursday of the month. Right? Now, I'll have to rush in for 5-10 minutes because the important part is there will be a question and answer session for 20 minutes. So we have to take that and there will be a feedback. So we'll take a break after this particular session and then we will come for question and answer session. So what is this telling us? This is data understanding, right? Data understanding. Okay, I will take a break for 2-3 minutes. You all can put in your, clearing means expiry day, right? Probably feedback form has been sent to you. I think so we've been spoken. I'll also take a break for 2-3 minutes. You all can fill up the feedback form and then we'll start after 5 minutes and then we'll take the question answer session. Right? Is this fine with everybody? You all can fill up your feedback form, take a 2-3 minute break. I think you guys are also sitting. Yeah, that's great. And then we'll work out with this proprietary tool. Yeah, we'll do the proprietary tool. Don't worry. I'm not going anywhere. I believe in friends for life. So don't worry. I'm there. I'm available. It's not about the course. It's about sharing information. I would love if you all come back with some feedbacks and some improvement in the strategies. So go ahead. We are taking a break. Okay? 2 minutes. So my friends, have you all received the feedback form? We will start in another 3 minutes. So you all have 3 minutes time. Please go ahead, take your breaks. We'll start exactly after 3 minutes. Try to complete this in the next 10-12 minutes. We'll have a question answer session after that. It can be varied, not upon the strategies, anything to do with your trading, to be doing with your Bank Nifty. You can share your experiences. I'll share mine too. So we'll do that later on because we have a schedule. Probably we are already behind that. You will get this recording, sir. You will get the PPTs. You will get everything. Yes, absolutely. You're going to get everything what we have here. Just don't worry. I'm available. I have told the e-learn markets, Vivekji, Vinitji, the follow-up will be done. We'll try to finish it off by 5:20, sir. Sorry for the delay. Right, 1 minute to go before we start. Everybody in the seats, sir. The countdown is begin. It's nice meeting you guys, though even it's live on the net. Love to meet you personally some days. Yeah, please give your feedback. If any classes you all want, please work it out. I've told the e-learning people, Vivekji, Vinitji and the other team is there. They'll work it out. Great. Probably e-learning markets are planning a all India tour. So if you're there as a member, probably they'll inform you. Right, so we start. It's 5 o'clock. We start. We have a target of 10 minutes. Right. So let's start. Don't worry. Those people who are late, who have missed the classes, we missed everything, we'll work it out. You will get the PPT. I'm available later on. Don't worry. Just go with the flow. Yeah, here we go. The high, low and the close of the weekly sessions. The high minus low is an indicator of volatility. The higher the high. So what you got to do is just simply go down in that Excel sheet. You will get to know something called average. The average is 625. So anything that is 40 to 50% below the average is a below average market. So the volatility is mean reverting. Periods of low volatility are followed by periods of high volatility, right? The other number is high minus the highest high. So what is this telling you? Probably if you go down here, the highest minus the highest high. So this high minus this high, right? So if the number is minus, that means it is a lower high. And if it is a positive, it is a higher high. So now you, basically the numbers below 100 plus 100 tells you that the market is less volatile. If the number is greater than 100 or 150, the market is more volatile. So as of now, you are having normal volatility because this period is plus 189, plus 200. The last 3 weeks have been normal in case of volatility because it is making higher highs on a weekly basis by 150, 200 points. Now there is one secret here, my friends. Can anybody guess what is the secret? I'll give you 20 seconds. The answer is in the bold. Just look at volatility of the last week of the clearing. 450, 795, 593, 767, 994, 800. The last week of the markets are generally trending. Why? Because there is huge open interest position, as I showed you in that monthly charts of the open interest, and they try to make advantage either one day before or the last day of the settlement. Why? Can anybody answer? Why does the big market movement happen one day before the settlement or the last trading day? Correct, because the option premium are the lowest 2 days before the clearing. Premiums are cheap. They buy the premiums and it's a trending market and they make big money. 1 rupee call option can go up to 300 in a matter of 2 hours, my friend. This type of returns in a portfolio also you will not generate. So you must know the last trading sessions are the key. Markets are going to give big breakouts. So you got to be finding very good entry areas and keep holding for the clearing sessions, some positions. So you will tell. So you just have a look. 290 points from a high to high. Last monthly session. 433 points. 2197 was a high. It made a high of 22,280. So if you're buying on the breakout also of the high and you're holding the positions, a 20-30 rupee call, you're making 200 rupees. This is where wisdom comes in, my friend. You can buy a 30 rupees out of money 100 point call 2 days before the expiry. This sheet has been given to you for your observation. This is how I observed and how I learned about the market. I was trying to find out where the big buyers and the sellers are trying to enter the market. Right? You have to be alert. This sheet will be mailed to you, each and every one of you. You got to fill up this sheet with your own hands at the end of every clearing last Thursday. Just have a look. So this will be 15/06/2017. You got to fill up the high, low, close. You can just go to chart link. Automatically, this is high minus low. Just put in the formula. This is high minus highest high, low minus. What I'll do is to you, I'll send a proper Excel sheet with the formulas and it should go to you on Monday. This is nothing but the formula, sir. This is high, low, close of the clearing week, Friday to Thursday. Weekly options for the Bank Nifty weekly option. This is nothing but high minus percentage of the close close minus previous close divided by previous close into 100. You will get the formulas, don't worry, here it is. Right? When the premiums are low in the monthly contracts, if you see there is huge volatility in the monthly contract week, you got to buy those premiums in the monthly contract because the historical probability tells you that you find the trend is a buy, you look to find and you look to hold the low premium contracts at least till expiry because you make big money. So this tells you about this particular concept. Now, yeah, that is a separate, you have to buy 100 points out of money strike price when you're buying. This is nothing but the same concept which is a monthly concept. The monthly Bank Nifty high, low, close. Right, Raghav, we'll do that, don't worry. This is again the same percentage close. This is again the percentage close. This is a volatility high minus low. The formulas are all there. Volatility high minus previous high. This is the same. What it tells you is the bigger picture. Right now, in the June clearing, Bank Nifty has just moved 2.4%. That is high minus low, percentage wise. Which is, this is spot. Always use Vishal the index prices. Right? There's nothing major of a difference. But always index because at the last day the Bank Nifty settlement is done through the cash price. Right? Okay. So you got to fill this up on a daily basis. The volatility is low. Now what it is telling you that Bank Nifty is going to give a very big breakout either above 23,700 or below 23,093 because if you see the average is close to about 5 to 6% and the last 3 months it is below the average. So there is a big movement which is going to happen. So as we have seen the option chain 23,500 is now acting as a support. You see what is it? This is nothing but a volatility indicator. Volatility, what it tells you that the market either will make a newer high or a near low because the average movement in a settlement is about 1,000 points and the market as of now has just moved 650 points. Monthly settlement, the average movement is minimum 1,000 to 1,200 points, which you are getting it from the percentage wise. You can just simply put in high minus low itself. You can do that also. Right? How do we do that? Simple. Let's change the formula. We don't require the percentage. So you just go there, high minus low. So it just tells you what is an average movement. Yes? So what is it telling you? Minimum average movement is 1,000 points. Can you see? Is everybody able to see this? We are just 565 points, the index high or low has been made. So if it is a buy trend and if we know the markets are bullish, we know that the 23,500 is a very good support area on the charts, on the option chain, everywhere here. And if the prices hold 23,500 and you add another 500 points to the current price, so we are heading near 24,000. So common sense tells you what? If prices hold 23,500 as per the option chain, as per the studies we have done, we are going to see a target of 24,000 by our study methodology. Now where will this trend break? If 23,500 is breached and it closes below that, then probably the bears are in control. We have to look and then find out whether the new support and resistance areas are going. But as of now, this is the premises which we are working on. Correct? This is as per the strategy. So this tells you the volatility. This tells you the higher highs, higher lows, which is right now normal. Nothing major. The percentage is normal. The Bank Nifty has not given very much huge movement. It was 23,190. As of now, yesterday it was 23,690. So it has given a 2% movement. So it can go up also and the closing might come down. So 24,000 here also looks like a intermediate target as of now. So this is a very simple Excel sheet, my friend. What it tells you is it gives you the basic idea what is an average movement of Bank Nifty in one monthly settlement and one weekly settlement. Right? Now, what it tells you is you can plan yourself whether there will be a breakout or not. It has just given 565 and you know there's a 1,000 movement, average movement. So if it starts going up and making new high, right? Right? So you're going to go up. So now there is a question which is very important. We look for corrections. Now, where are we looking for correction, my friends? We are looking in the 5-minute chart for correction. So it might happen that the market goes to 23,800 and corrects by 70-80 points, which the market normally does at every high. So in our technical patterns, we are catching those trends. But what it tells us, this is a confirmation that if 24 is the target near the clearing and we are buying, so when we are booking, profit booking, instead of booking 75% profit, we book 50%, we keep the remaining 50% for higher targets. Right? So these are all confirmation indications. The option chain was a confirmation indication. The weekly Bank Nifty volatility options are telling you about the volatility of the market and where we are at present. So these are all confirmation to our trading strategies. Right? This is where we use wisdom. This is what we should not do and what we should do. If the volatility is very high, there is no need to trade. If the market has already given 1,000 points upside movement in the beginning of the clearing, be relaxed. Let the markets correct. Then we'll get back into the market. So that is wisdom. So that once you start recording the data, recording yourself, recording your experiences, that is where you become a better trader, better investor. Right? Now there is one bonus which I have kept for you all, a short money making technique. Credit policies. What is the credit policy? Every 2 months, Reserve Bank of India comes and decides on the interest rate, which affects the banks, which affects the lending and the borrowing, which in turn affects the whole country, including you and me. Right? Now, what do we do? Now, these are the dates. Credit policy in 2017-18, June 7th, April 7th. Right? What is a low risk trade? My experience, I have seen 10 minutes before the credit policy, if the market is trading at the highs of the day, you buy a put. What happens is 5-10 minutes just before the policy or just after the policy, market gives the spike down. Please understand, 5 to 10 minutes before the credit policy, if the markets are at the highs of the day before the policy is to be announced. These days the policy gets announced at 2:30. So from 2:20 to 2:25. Right, sir. So we buy very out of money option because Bank Nifty gives a spike down of 150 points. So if you are wrong, we are buying a 10 rupees put. If you are wrong, we lose 3-4 rupees. And if you are right, the 10 rupees put, if you put in a bid, it goes to 24, 25, 26 rupees. So you make 5 times the money. Right? And this is a strike rate of more than 50%. You can test it out on the dates. If you have intraday data, I will show you one of the dates. The last one. I have tested this over the period. So let's go to Bank Nifty. Yeah. So the credit policy was, you guys are probably trading, remember, it was on 7th. Just have a look. It was trading at the high point of the day. 10 minutes before the policy, market zoomed down by 150 points. So your 10 rupees put would have been 20-25 rupees. So the caveat here is it should be near the high point. If it is near the low point of the day, you should buy calls because there will be volatility and there will be spikes. So when you buy that call in the put, you put in your bid at 2 times, 3 times, 4 times your stop loss level, small quantities. There's a very high probability that will eat up. Right? Bank Nifty, there are 6 days a month. You should take out all your money if you are a trader by this strategy which I have shown you. It has a very high probability. Right? Great. So we move into the next particular strategy. After the credit policy is announced, 15 or 20 minutes after the credit policy, what is going to happen is, the markets will trend in one direction. That time you have to forget what is the trend. If the markets are going up above any critical support level or going down below a support level, you have to buy, call or put for the next 1 hour till the trading ends. Right? Because it's a trending market. So what you can do is, these are the various dates I have given you. This is one, you can say, homework, right? You basically go and have a look in these dates where the markets were near the highs and the lows of the trade, and you had taken a trade 5-10 minutes before that, and whether the bank nifty is given a 150 point spike or not. The first thing is the markets before the credit policy should be near the highs or the lows of the day. 10 minutes you start taking the trade. If it's at the highs, you buy the puts, and you exit 5 minutes. You put in the bids. The bids do not get triggered. You exit 5 minutes after the credit policy. You have to put in the bids because the spike can come before the credit policy or after the policy. But if the spike does not come in your favor 5 minutes after the policy, you have to exit in the market. Very simple trade. After 20 minutes, the policy announcement, the market will start to move in one direction. There will be volume, and wherever the support or the resistance, you just have to buy that area. You do not have to question your trend the day that you have to forget the trend, because that is itself a new trend or a start of a new trend. Right? Very important thing which my friends also understood. Last day of the weekly clearing. The point which I missed out, I'm coming back to this. You have to track HDFC Bank. If HDFC Bank is given a breakout, that is a further confirmation that today is going to be a trending day. Bank Nifty gives a breakout and it is trading at the highs, and HDFC Bank has given a breakout. It is a confirmation, especially 2 days or 1 day before any clearing, that the market is going to trend, going up by 100, 200 points. So these are your tools which you understand that this is where the markets are going to head. So we know the direction. What is our edge? Direction, near the intraday support area, small stop, bigger profits, confirmation by the option chain, use of volatility tools by the weekly and the monthly clearing to understand future and probable directions of the market and possible price targets. And you got a bonus of credit policy. Any questions? Please shoot. We have 10 more minutes before we wrap up for this webinar.